key question mark is whether indeed the Fed will move. And if it does move, will it be 50 or will it be 25 basis points? Daniel Lacalle is the chief economist then at Tressis and joins us now. Daniel, thank you so much for the time. I mean, what do you make of that? Are markets just doing what they did at the end of 2023, expecting too many rate cuts at this level?
Hi, Arbili. Absolutely. Markets continue to expect too many rate cuts and a very aggressive change of policy for the Federal Reserve, which is exceedingly unlikely. Furthermore, when we see corrections like the one that we have seen in the past week, what happens immediately is that the Fed does not find itself in a big hurry to cut rates aggressively because bond yields come down and the economic situation that they actually look at, growth, jobs, inflation, they're all moving in the direction of their target. Therefore, I think it's very imprudent to believe that the Fed is going to make a U-turn. Will they cut rates in September, maybe 25 basis points? Probably because all of the elements that they're looking at are actually moving in the right direction. But it's also true that inflation remains persistent, and there's a fear that producer prices in particular will actually bounce into September, probably into October. So all of these things will maintain a Fed that will continue to give a sort of prudent message. I don't think that you can expect a U-turn or, as I have read in some places, a very aggressive decision to start cutting rates in the order of 100 basis points, which looks to me very, very difficult.
Ultimately, one has to look at this, Daniel, and think, well, was the market not primed for this downturn in many ways? Because we had been speaking previously, before this all happened, about how valuations had ultimately spiked stateside quite significantly. There needed to be some drawdown and perhaps a rotation into smaller caps at play. Plus, of course, there is going to be this unwinding of these restrictive rates. As to how that happens, we'll certainly see. And of course, at some point, the data was going to be weaker. Is the market looking at this and saying, well, we need the Fed to be a little bit more worried about the state of play here because actually a recession could even be in play? And let's remember, we do have one more non-farm payrolls data piece to come out before the next meeting.
I think that what the market is telling the Fed is that, yes, the headline figures on the economy are positive. The earnings outlook is not that bad and unemployment rate is positive. All of those things are headline figures. But what the market is starting to tell the Fed is that things are not that rosy in the real economy. And it's proven by the disappointing results of some of the names in the Russell 2000 and some of the, let's say, more granular elements of both of the jobs data, but also of the inflation and growth figures. So I think that there has to be some kind of compromise here in which the Fed starts to understand that there is a significant damage happening because of rate hikes in the real economy, in families and small businesses. It is true that the very large corporations and the government have not suffered because of the rate hikes, and that the headline figures are acceptable, even positive. But what we need to understand is that there is a very significant burden on families and businesses that is actually creating the elements that may generate the recession that you just mentioned. So I think that the Fed needs to be a little bit more closer to the ground and remember that the rate hike path has actually fallen entirely on the shoulders of small businesses and families. And therefore, they need to find some kind of compromise that doesn't lead the economy into a recession simply by ignoring the sort of more detailed elements of the jobs figure, the employment to population ratio, the labor participation ratio, the level of growth that is actually coming from the private sector and not from the public sector. And all those things point to a very significant slowdown in the economy. So the Fed needs to be more in tune with the reality of the real economy before it actually makes a policy mistake.
Dan, on that point around the unemployment rate and what's playing out in the labour market, those who are trying to piece together evidence that we are in recession or heading that way are saying, look at the SAM rule. Effectively, if you get a change by half a percentage point up from the unemployment level, which we've moved beyond that, it could be a sign we're already potentially in recession. It's some sort of indicator. But even the person who coined that indicator is now saying this time could be different. So is the SAM rule at all relevant these days?
I think it is relevant. It is not a tried and tested rule that is going to work all the time, but it does show that there are significant cracks in the economy that need to be addressed. And the employment figures are very relevant also if you look at what comes from the private sector. Remember that in 2023 and at the beginning of 2024, the number of jobs created in government has been very elevated. And at the same time, I come back to the points, the employment to population ratio, the labor participation ratio, and obviously the unemployment rate, which is at 3-year highs, are showing that things are not that good. And obviously real wage growth is actually back to negative territory. So all those elements tell you that there is a difference and a disparity between the headline figures of GDP and unemployment and the reality that the small businesses and families perceive. That is very evident with the ISMs and with the PMIs, but also in GDI, gross domestic income. So what I think is that the Fed needs to look a little bit more at those details and see the burden and the impact that is happening on the real economy and act accordingly, obviously without losing track of the fact that inflation remains persistent.
Yeah.
Very challenging situation for the Fed, to be fairly honest.
Dan, that said, do you believe the market slump has been a buying opportunity? Just explain that to us.
Well, why is it a buying opportunity? 3 elements. Number one, the earnings season has been actually pretty good. Not just pretty good in terms of the actual earnings published, but also in terms of guidance. I think that that is a very significant element because it reduces the possibility of very significant downgrades. What we have seen is disappointment from investors on earnings that were actually pretty decent and sometimes actually beating. The other element that I think is important is what we just said, is that although the economy is slowing down and is slowing down in a way that we should pay attention to, it is not anywhere close to a recessionary environment. And the number 3 is that the fiscal policy is so aggressive that investors need to pay attention to what is going to happen in 2025. All of the hawkish messages and all of the prudent messages of central banks in 2024 will have to revert in 2025 because fiscal policy in the United States in particular, but also in the euro area and in Japan, is moving in the opposite direction of monetary policy. So monetary policy will have to be accommodative in 2025. And therefore, we need to pay attention to those elements, not rush and think that everything is over and that it's just buy everything and anything, but look at good opportunities because those opportunities are coming right now in an environment in which there will be a significant easing process in the next 2 to 3 years.
Dan, thank you very much for joining us today.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.